Welcome back to the channel. What a wonderful few days it's been. The Wall Street Journal article on composer, algo trading, and myself was published. I got a wonderful response, lots of emails on LinkedIn, text messages, so on and so forth. I wanted to thank Bob Henderson. I think he did an admirable job. I spoke with him for, I want to say 40 minutes to an hour. And so he had to compress that whole interview into a few sentences, a few quotations. It's always a difficult job to do that. But I think he did a fair job with me. I'm happy with it. I would speak to him again. I'd recommend him to others, so on and so forth. So here is the article here. Bob Henderson was published at 5:30, January 20th. Funny little story. When I opened this, and I got up at 6:30 that morning to see it because I didn't know if it was going to be a negative article or if it was going to, portray myself or composer in a bad light, which it did not. And I was able to see my name here, but I wasn't able to see the full article because I don't subscribe to the Wall Street Journal. Maybe now I will, but I hadn't, so I could only see my name here, and it took me 5 minutes to finally access the article. But anyway, so Pietros Maneos trades stocks like many of Wall Street's most sophisticated operations, running dozens of computer-driven strategies in parallel to chase market-beating returns. But he isn't some tech-savvy math type. He's a published poet who doesn't know how to code. Very true. I don't know Python. I don't know how to integrate Python into an API. And so Composer allows me to run these ideas and strategies that I've developed in collaboration with others in the Discord and some individually. And it goes on to say, Maneos, 44 years old, uses online trading platform Composer.trade to build, test, and bet on quantitative trading algorithms that buy and sell stocks and exchange traded funds out of his home office in Boca Raton, as you can see where I am. One algorithm, for example, holds a triple leverage exchange traded fund tracking the NASDAQ 100 index if the S&P 500 index has recently trended higher and treasury bills otherwise. That one, I believe, is enhanced momentum. I did a full video about that, so you can just scroll back my videos, which I call that a second generation symphony. He is currently running 72 such schemes he constructed with the application's graphical interface, but can also type requests in plain English that Composer's AI will translate into code. It's like having my own personal black box, he said. You could argue that I'm a hedge fund with 72 strategies. Exactly. I've always been attracted to Composer for that black box element that, again, unless I knew Python, I wouldn't really be able to integrate. One of the reasons I like running what I call multi strategy. So someone running 5 symphonies would be considered multi-strategy, but I'm at 72, and I'm actually going to be running more recently, but I'll get to that in a little bit. To me, it gives it that black box approach. Maneos is one of the growing group of regular investors adopting the techniques similar to those that have exploded across Wall Street since the success of Jim Simmons and his Renaissance Technologies hedge funds launched what many call the quant revolution. So-called quant funds use algorithms coded into high-powered computers to spot market signals and automatically buy and sell stocks and other assets accordingly. Practitioners say quantitative investing utilizes far more information that can be crammed into any human head and can keep emotions from clouding trading decisions. Exactly. There would be no way that I'd be able to track 72 different strategies on something like TradingView and figuring out, okay, now it's 350. I need to run to the computer and execute those individual strategies and have an Excel spreadsheet to track how much capital is in each. And to that point, there's a great book, The Man Who Solved the Market, which is about Rentech. And in that book, there was a period in, I want to say, December of 2018, when the market was going down, and I believe that people in Rentech were saying, let's pull the algorithms because it's too much volatility, it's too crazy. And I believe that Jim Simmons said, no, let's run our algorithms, and everything has done quite well. But yeah, so that's the interesting thing there, is that you can have an algorithm, but if you don't have the temperament to stay with it, it's a whole nother matter. Some algorithms load up on riskier assets during calmer periods. Others seek to divine and follow price trends, but all tend to spring from similar source, a cadre of coders with deep market knowledge, often PhDs in math or physics, who design and build their models. Here, look, you can see this is me here, and this is me here where I'm sitting. So pretty interesting. So it goes on and it profiles some others. And I knew they would have this. In my mind, I knew they would get someone. I thought they would get like maybe Ernest Chan. He's written books on algorithmic investing, or someone at one of the big quant firms. But I knew they would have a counterpoint to Composer and to what I'm doing, coming from an expert. Now, I'm not saying this gentleman isn't an expert. I'm just saying that I knew that they would bring in, again, I thought it would be Ernest Chan. But anyways, now retail investors can act just like their quant idols, build overly complicated models that look unbeatable until the day they go live. It said hedge fund veteran. So there you go, hedge fund veteran. Andrew Beer, managing member of investment management firm DBI. It talks about my returns, 33%. So yeah, so again, very happy with it. The commentary that I received was excellent. And then you look in the comments section. I always I have friends that, that write for Seeking Alpha and that do YouTube videos. And I always say, beware the comment section. So not beware the Ides of March, beware the comment section. A lot of the comment section, whether it's a video, an article, is snarky, full of schadenfreude, hate, envy. It's the worst of humanity, basically. Oftentimes it's negative. And there's some counterpoints, but just wanted to go over a couple points on the comment section and some of the critiques. To be fair, some people in the comment section don't have the full context of my investing. And so a lot of them came at me through the prism of the holy trinity of fundamental investing. So specifically Jack Bogle, Warren Buffett, and Charlie Munger. And so they were using aphorisms and sensibilities from Munger, from Buffett, from Bogle to critique this. For example, Jack Bogle referred to leverage ETFs as, quote, the lunatic fringe. So just to be transparent here, and again, these people haven't followed my many YouTube videos. They didn't see the year-end review where I show the 33.3% with a screen share. So they're, maybe challenging it that it's not possible or that it's fake or this. But I wanted to make this point actually about it, is I actually have come to Composer from more of a fundamental side of investing, from reading the trinity that I mentioned, the Buffett, Munger, Bogle, as Peter Lynch, so on and so forth. And so I think that actually gives me an advantage, because many people come to Composer from more of a day trading, swing trading background. And so they're more likely to jump between symphonies. They have a shorter term time frame. Because I have a longer term time frame, it's why I actually did quite well last year. In my year-end video, for example, I mentioned one of the particular strategies that was down 30% in the beginning of the year that ended up over, 70, 80%. And had I sold when it was down 30%, I wouldn't have realized those returns. So because I have a sort of a Rip Van Winkle, Jack Bogle sensibility, it does well for me. The other point I'll make, and I said this to Bob, but again, it's a 40-minute to an hour interview that's condensed into a few quotes. He said to me, well, if you believe in these strategies, why don't you have 100% of your capital in there? And I paused and I said to him, Bob, have you ever read Roger Lowenstein's book, When Genius Failed? And he laughed, and I think he was impressed that I even knew that book, because again, he didn't know me from anyone. And maybe he thought this was like a sort of a lowbrow internet crowd or something. And but yeah, so that's obviously takes long-term capital management. And actually what I do here is, and I'm going to go to this other screen and then come back, I have more than double, and this is just one account. I have a Vanguard, which is very similar. So you can see this is a Schwab account, 521,000, up about that $1,100 today. 2 year. This is actually 3 month. This was transferred from TD Ameritrade, but this is a vanilla index blue chip dividend payer portfolio that would make Jack Bogle smile from ear to ear for the most part. I mean, the only thing that would make him smile from ear to ear would be if all of 521,000 was in VOO, perhaps. But there's a lot of vanilla index funds, some some blue chips. I think even Berkshire Hathaway is included in this. And so I feel, and I use the term golden parachute. I feel that the 521,000 in these vanilla index fund strategies, sort of more passive investing for the most part, allows me to be aggressive with a certain percentage of capital. Jim Cramer on CNBC, literally the name of the show, Mad Money. From my understanding, he used that term Mad Money, which is you should have a large portion of your portfolio indexed, but you should have some mad money. And his mad money is basically for him active management, buying and selling stocks, taking more risk with that mad money. But I want to make the point that Composer's trading platform software is not simply for someone looking to do a mad money or an aggressive triple leverage ETF strategy with nested symphonies within symphonies. You can actually have the soul of Jack Bogle, Warren Buffett, Charlie Munger, and use Composer. And you might say, well, how? So if you actually go to Composer and you click on the Discover page, the community are going to be some from the Discord, again, more aggressive strategies. But you can see here, copy the great. So you can have the soul of a passive indexer. You click on this and copy Warren Buffett. And right here, this is going to be Buffett's 90-10. And just for perspective, they'll do the breakdown. It's rebalanced yearly. It's VOO, VGSH, short-term bond. Just for perspective, people don't know this. When you're investing in the Buffett, you're not actually following along with Warren Buffett's investing. What you're doing is you are emulating Warren Buffett's 90-10, which he said in his will, upon death, he wants, not for his wife and all his charities, 90% of his money held in VOO and 10% held in short-term bonds. And, whenever Buffett is interviewed, he argues for indexing. Now, Buffett didn't make his fortune indexing, for example. And if you want to follow along with Warren Buffett's investing, then you would want to buy Berkshire Hathaway stock, because you're going to be owning Berkshire along with everything that they own. But this is my point. Actually, it makes me think of a YouTuber named Rob Berger, who's very much a Vanguardite, Bogle disciple. And one of the things he said in a video we were watching is he said, if I were starting today, I probably wouldn't use the Vanguard platform. I'd probably use M1. And I think the reason he said that is because M1 offers rebalancing. And this was, I think, before Composer was created, or just when it was starting, as a smaller company. But you can do this rebalancing. In fact, this is rebalanced once a year. You can set this, for example, to rebalance quarterly. You can set it, and you could, set it to threshold. So I think someone like Rob Berger could look at M1 or Composer and say, which of the two, do I want? Composer to me has a lot more to offer than M1, but there's nothing wrong with M1 at all. And the other thing is, at some point I could simply roll that 520,000 from Schwab into Composer and hold, and I would be comfortable doing this, 520,000 in VOO, and the rest in some of the more third generation Discord strategies. I would sleep well at night with that. And you could do something, and again, I could create this in Composer. I could create more of a balanced vanilla index equity portfolio in Composer. Let's say VOO, DIA, QQQM, NOBL, SCHD, VIG, VNQ. So I don't know, let's say what, 8, whatever I listed there. I could say that I want 50% in VOO, DIA, QQQM, and then the other 50% in the others. Something I could very much do. So you can run a conservative bogle head kind of portfolio in Composer. So it's not, just because the Discord has gone another direction with, again, the third generation style symphonies, nested conditional, so on and so forth. You don't have to. You can use it like you were using Vanguard or M1. So yeah, so that's that. And then basically wanted to go over here. And then he mentioned in the article wash sale. So I just want to give an update. Actually, I want to come over here, I think. And this is another point I wanted to make. So, and again, for context, these people didn't know I existed before. That's kind of a cool, the circle there. These people didn't know I existed before the article. And I doubt a lot of them taking the time to go watch the year-end review video where it's literally a screen share from January 1st to December 29th, showing the amount of capital and the actual returns of individual symphonies. And I thought, and I said this to other people in the Discord, I said, one of the reasons for my 33% return, which is phenomenal, right? If you can compound capital at 33% for the long term, you're doing wonderful. I think that people's heads would have exploded if I actually were even more aggressive, because I had a certain amount of capital in some fundamental strategies and in some first generation legacy symphonies that I was holding. But you can see some of the third generation symphonies, 152% or 162%, 161, 86, 84, 82, 67. So if I allocate it to 1, 2, 3, 4, the top 5, let's say, or just all of these, right? The top 7, which are more the Discord strategies. The return, instead of being 33.3%, might have been 85%, 68%, 91%. Their heads would have exploded. So it's, in a way, it's good that it's only 33%. But there you go. So one of the things he did mention is the wash sale. There we go. I just wanted to minimize that, which is very true, and it's something that you really need to take into account with Composer. So one of the things I'm actually doing now is I'm doing what I call a capital reshuffling. I had a meeting with Brian Rivera at Trader Tax CPA, and so I'm moving about the 200 of the 250 into an individual account that's designated as Trader Tax Status. I believe it's TTS, with specificity mark to market election. And what that does is it prevents disallowed wash sales, which he referenced there, which can be a nightmare for a day trader. And there's horror stories of people, trading with leverage and making 50,000, but having to pay tax on what's called phantom gains on 100,000. I'm not going to go down that rabbit hole too deep here in this video, but just to give a quick example, if you buy a stock at $1,000, let's say it goes down, you sell it at 600. Normally, you'd be able to use that $400 loss in your taxes. But if within 30 days you repurchase that same stock, that loss is disallowed. So it's called a disallowed wash sale. So the example would be, you buy it 1,000, you sell it 600, you think you have 400. But let's say the stock rebounds, or you're in an algorithm, and for whatever reason, the algorithm or you individually say, let's buy it back at 800. Okay. So now that 400 is lost. So now you might think your cost basis is only 800 because you purchased it back at 800, but really it's 1,200 because that 400 was disallowed. Okay. That's the issue. So now you didn't make money, but your cost basis is $1,200. So the advantage though is whenever you do end up selling, so like whether it's that year or the following year, let's say you buy it at 800 and let's say you sell it at 1,200. Well, you think, oh, now I have a cost basis of 400. Actually, your cost basis is 0. You have no tax to pay because of that disallowed wash sale. You might want to rewind that. If you, again, it's very complicated. So there's a lot of YouTube videos on it. You can, meet with someone like Trader Tax CPA and other CPAs to really go down that rabbit hole. But by doing a mark-to-market election, what that entails, basically, let's say I have 200,000, because that's what I'll have, I believe, about 200 to 230 in this account, because I'm leaving a certain amount in the original account. But let's say I just have 200, it's a nice round number. At the end of the year of 2024, I'm at 300. Well, I pay tax on that 100, but there wouldn't be any disallowed wash sales. So if it's mark to market, put 200 in, the account's at 300, that 100 is where I pay. If I put 200 in, the account's at 100, I have a loss of 100. So that's how it's set up. What I am doing is I'm actually keeping my original Composer account with about 50,000. And the reason I'm doing that is um, it is something where those are only quarterly and yearly strategies. So the wash sale number is 30 days. So if I'm selling quarterly or yearly, it wouldn't affect it. I wouldn't have that issue in that initial account. And then the daily strategies are in this new account. So yeah, so that's that. I'll just finish out. I'll just kind of scroll through some of these comments here. Let's minimize the screen. See, here you go. This gives you a sense of sort of the nastiness. And again, maybe the guy doesn't have perspective on all my YouTube videos. The fact that I have assets and passive investments. The fact that some of the strategies were actually 70, 80, 90%. The 33 was because it was balanced, whatever. A bunch of leprechauns on unicorns chasing rainbows, hoping to find their lucky charms. And then actually this guy here kind of defends. He sort of challenges this guy, Rich S. I take it you don't believe algorithmic trading works. He goes, yeah, I don't believe a human can write a code that predicts billions of transactions in the global economy. Only suckers, sociopaths, and the desperate think you can time the market. I wonder if he would have walked into Jim Simmons' office when he was, I guess it was called Monometrics. They had an office in a strip mall somewhere. They were working away, and kind of said that to them. Or if an investment advisor or Burton Malkiel or Jack Bogle walked into, D.E. Shaw or Rentec or Two Sigma when they were starting out and said this, but whatever, And then he goes, do you think the code can sometimes detect trends in prices or volumes? He goes, again, he's repeating this he's regurgitating Jack Bogle. That is timing the market. So you might be right 4 to 10 times and wrong 6 out of 10. And then you end up underperforming your own investments. Even if by some miracle or someone did figure it out, when you take risk out of the equation, your rate of return will go down an equal amount. Market timing is a hobgoblin. And this guy again defends it. It just goes on. 33% when return is clickbait. Again, I'm not advertising it as if to raise capital. I've been approached by different people. I don't run money presently. I may in the future, but this isn't an advertisement for me. And he's right. Look, next year it might be completely different. I'm fine with that. This running in front of trains to grab a few dimes. Again, this is a more aggressive approach. Much of my wealth is, I didn't even mention real estate. That I've, 27 pieces of real estate. That's a whole nother issue. This is just brokerage accounts, but, so this is interesting. How many hours did it take and what was the loss opportunity cost of spending all those hours in front of his screens? Hours he should have spent with loved ones, reading, exercise, playing, living life. We worry about teenagers and their screen time. Maybe we should start worrying about these guys too. No need to worry about me. I'm good, my friend, Carl Fiend. But yeah, that's a valid point, but I enjoy it. It's a pleasure for me. I garden, I go to the gym, I collect books, as you can see behind me. I like to grow peppers, specifically Italian ones, right here, as both an Italian and an Italiophile. So I do all the things that I enjoy in life. I very much love this. So it's a passion. I stick to simple investment strategy. And again, I do that as well. That's what the point I'm making. And in Composer, you can do this as well. You can have just stock index funds. Comparing it to Las Vegas. Again, here we go. Reference to Bogle. I'll take my chance to Jack Bogle. I will too. I have, again, large percentage indexed. And I'm not offering you to take a chance with me. I'm not saying give me your money in any way. So yeah, so we could go on and on. There's like 185. And again, some are nice, some are, and this was actually a good one. I want to talk about this one. The big money is not in the buying and the selling, but in the waiting. And again, this is from an earlier point that I made. I think, and I used to use this quotation when I speak with other Composer users. You created the term symphony jumping. And why did I do 33%? Maybe there's other people who didn't do well, even when the market did well. because I've come to Composer from that Warren Buffett, Charlie Munger sensibility, I take a more long-term approach. To quote, another one from Warren and Charlie, it's not IQ, but temperament that determines results. And I believe that's specifically Charlie, not Warren. But so, for example, a Python engineer, coder, math, science person with a huge IQ can create an amazing symphony. But if they don't have the temperament to endure a 35% drawdown in that symphony, again, I use beta ball as an example that I did tremendously with, and they sell. They're in the buying and selling and not in the waiting. So I use that waiting as this form. I allocate to symphonies, and generally I take a Rip Van Winkle hands-off approach that if they're tested, back tested, I believe in the logic, then I allocate and I let them be. Ideally, that's the goal. So so I'll finish with that. I think, again, because a lot of it's repetitive, there's more quotations from Jack Bogle, Warren, Charlie, fundamental investing. But yeah, so it's a little bit longer here. I'm at 26 minutes. So okay. But yeah, any questions, comments, feel free to reach out. Again, thank you to Bob Henderson, to the Wall Street Journal, to all the positive comments that I got on, phone calls, text message, LinkedIn, the Composer Discord, so on and so forth. But yeah, that's it. I think the next video I'm going to do is I'm going to showcase, once all the capital reshuffling is done, I'm going to do a screen share and kind of really showcase that. I should be done that in another week or so. So I'm going to kind of showcase that. But anyways, take care. Ciao.